Okay, so let's start with the reality checks, right? So have you ever stared at your charts or your trading terminal? A clean chart setup, you've identified, you've checked all your boxes, you've waited for price to come to you, you've waited maybe a day or two or a couple of hours for it to get there, you set your alerts, you've sized up your risk, you've checked all your boxes, right? Then you clicked buy, and then you just instantly watch the market instantly crash in the opposite direction because of some high impact news or economic event dropped or Trump tweeted out of nowhere. Has it ever happened to you? Yes. If you've ever felt the absolute frustration of a perfect technical setup, perfect, like this thing was 100% perfect and you know you are making money off this trade, and it just got completely wiped out by a single line of, I don't know, just one candle, then you're definitely not alone. So if you've ever watched also a winning trade, right? So you're in profits, you're like, okay, I'm not going to move my stop loss to break even. I'll just wait for it to, hit my full TP because I'm following my rules. And then it just turns into the market overturns and a deep pullback or retracement starts happening. Price just keeps pushing in the opposite direction. And then you watch a winning trade turn into a painful loss simply because maybe you didn't know what was happening behind the scenes. Then you know exactly what I mean. Okay, so drop a comment down below if you've ever been blindsided by any of these things, or you've actually forgotten at one point in time that maybe there was news coming out and you were in a trade and you didn't see it coming. Well, here is, I think, a core problem that we're going to address in this video. So most retail traders treat currency pairs like random lines on a screen, especially if you're just a beginner, right? It just looks like it's an up and down motion and I just need to buy or sell when it goes up and sell when it goes down. And this is a big problem because then you can end up ignoring massive macroeconomic engines that actually drive these prices up and down arbitrarily, guessing the direction based on, your technical drawings here and there. I mean, very recently there was CPI and PPI news, and, from a technical perspective, guys were looking at sells, but fundamentally, it ended up buying, and those who were in buys actually ate good. So this is the cost of flying blind. So let's look at the agitation of this particular mistake here. So when you trade without understanding fundamental or macroeconomics, you essentially flying an airplane with your eyes closed, potentially. Then the immediate cost can be very severe, especially if you're trading very volatile things like maybe the Nasdaq and gold, and you suffer sudden unexplained stop outs. And you also experience very immense anxiety every time a red candle prints, and eventually you watch your hard-earned capital drain away, and it's very frustrating and anxiety-inducing. So then you end up feeling like the market is just personally out to get you, which is why a lot of retail traders are of the narrative that smart money is always hunting stops, and they wait for you to get into a trade for them to take you out and then continue. But again, this has been debunked by so many professional traders, very seasoned guys who've been in the markets for years, and they're saying that smart money doesn't have visibility on the trades that we are taking. They just manage their risks the way they do, and they have particular levels on how they actually trade and want to be involved in the market. But not to get into all the nitty-gritties and too much details of this, let's look at what we are talking about today, which is fundamentals and macroeconomics. Okay, so what if you could understand exactly why these lines are moving, or why price is moving up and down, why the candles are printing? Then you align your trades with the path of least resistance. Then you manage your absolute exposure or risk with professional precision. Well, today we're going to build an absolute agreement of sorts on how to interpret the global economic machine which drives price up and down, and how we can package and position ourselves to safely navigate broker leverage and also overnight fees and any other hidden costs that might be involved. So let's think through this a little bit logically and say, if you buy a share of a company like Apple, right? Or maybe Safaricom, what are you actually betting on? Exactly. So you're betting on the financial health and earnings and the growth of that specific company. So now let's take that exact same logic and apply it to a country, right? So if a country's economic machine is running smoothly with strong job growth, more people are being employed in the economy, more businesses are expanding, and the government is stable. So what do you think happens to the global demand for its currency? Exactly. So then global investors want to hold that currency to invest in that booming economy, which drives the value up. So fundamental analysis is simply looking at this bag of macroeconomic picture, instead of just guessing, we track concrete data points, employment rates, GDP, trade balance, and I think most importantly, central bank interest rates. So real world scenarios like what's happening currently at the moment, let's see how this plays out on your charts, right? So if you align your structural bias with these fundamental forces, the setups become incredibly clear. Let's look at an example. Let's look at Euro USD. So the euro as the base currency and the dollar as quote currency. Fantastic. So if US economic data starts weakening, okay? So the US economic data is weakening while the Eurozone prints a massive positive growth numbers. What is the logical path for euro against the dollar? It's going to go up. So to capitalize on this, you execute a buy order on Euro USD. Let's look at another scenario. USD/JPY. The dollar is the base currency and the Japanese yen is the quote currency. If the Japanese government actively states that they want to weaken the yen to make their electronics and car exports and everything else cheaper globally, while the US economy on this other side remains very rock solid, what then is the logical play here? Exactly. You back the strong currency. So then you execute a buy on USD/JPY. Exactly. This also holds true for every other asset that you're going to be looking at in the Forex markets or in the charts, commodities, metals, etc. So like gold is also a big commodity right now, big metal right now that everyone wants to trade. And it holds true because again, it's gold against the dollar. Okay. So whenever the US economy is doing a bit terribly, like the jobs report that came out or consumer price index that came out very recently was negative for the dollar, what did gold do? Guys who were in buys minted a lot of money. So when you decide to execute these high probability ideas, like we've just stated in the examples above, like Euro USD or USD/JPY, where we're buying, you don't just click buy and ask for a single dollar or a single euro, right? So if you head, as an example, to head on over to your local supermarket, buy eggs potentially for breakfast, right? Do you ask the cashier to sell you one single egg or half an egg or a fraction of an egg? Of course not. So then eggs are standardized into cartons or crates, right? Of maybe about 6 as the smallest one, then maybe you can have 12 and then a big large crate of 30. And this is because trying to trade them individually or sell them or move them individually becomes a logistical nightmare. Hence, they batch them into sizable, consolidated crates. So then the global financial markets and systems also operate the same exact way. Central banks and institutions package currency transactions into standardized units called lots. So let's look at the different lot types and what exactly they mean, right? So lot type, the volume or the unit of the base currency that you're going to be controlling, and then average account suitability for each as a recommendation for a beginner. So the very first standardized unit is called a standard lot. A standard lot means 100,000 units of the base currency that you're going to be controlling. This is massive, 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 massive. I think this one is just for institutional guys or large equity guys. And your account size for this one, 10K plus. Okay, if you have a 10K account plus, then maybe you can start using standard lots. The second standardized unit is called a mini lot, which is 10,000 units of the base currency that you're going to be controlling. This one is a bit of a mid-size type thing. So if you have maybe a 1K account to a 10K account, somewhere around there is where you can potentially start using mini lots just to keep your risk sizable relative to the account size. Then we also have micro lots, which is 1,000 units of the base currency that you're going to be controlling. This one is good for beginners and small accounts. So ranging from maybe as low as $100 account to a 1K account, you're going to be using micro lots, and that's where we suggest or recommend you to keep your risk appetite at for such an account. So now let's address a big hurdle that stops most beginners. Okay, so if a standard lot represents maybe a standard lot represents 100,000 units of a currency, right? So how on earth can a retail trader, you and me, with a $2,000 account participate in the market? $2,000 is even bigger, maybe a $1,000 account, or maybe I have a $500 account. How do I participate in the market? So then this is where the concept of leverage and margin actually comes in. So think of your broker as a premium financial partner, right? So they will front you the purchasing power, or they will allow you, basically you'll borrow from them the power and the position of $100,000, right? So then in return, They don't ask you for the full amount. They simply require a small good faith security from you, which is something like a deposit to cover the potential fluctuations. This security deposit is what we are calling the margin. An example, if your broker requires maybe a 2% margin, then you only need to lock in maybe $3,000, maybe $2,500, $3,000 of your own capital to control one standard lot of GBP USD, which is worth at this point in time maybe $150,000. So with $3,000, between $2,000 to $3,000 on a 2% margin, you can potentially control a position worth $150,000. That's crazy. And that's leverage for you. That's margin and leverage for you. However, it might all sound good, but it's all not rosy because leverage is a double-edged sword. It can be a trap. So you might be thinking, well, Will, this is fantastic, no? So why not just keep doing that? If I can control $150,000 or more than $100,000 position with just $2,000 in my account, and the pound keeps moving higher by a fraction of a cent, then while I take a short 20-minute break, maybe I buy GBP USD, go to the office, and then just hold it throughout the day, then I can easily make maybe $500 to $1,000. That's about 15-20% return in a few minutes, a few hours. Why shouldn't I go for maximum leverage on every trade? It only makes sense, no? Well, let me stop you right there. But this is because this is a very dangerous trap. And it's a trap that I fell into when I was starting off, and every beginner thinks that this is how they can get into the market, especially if you have maybe a loose 1,000 or 2,000 here and there, and you want to quickly get those financial gains. And why is it a dangerous trap? Because it costs you your hard-earned money. You will lose money. So leverage is an absolute double-edged sword, okay? So it accelerates your losses just as fast as it accelerates your gains. So if that massive, big 100K plus position that you're moving with your $2,000 account moves against you, also against your account just by maybe 100 pips, then what happens to your $1,000 account balance? It's gone. It's completely wiped out in a few seconds, okay? So your broker's automated system will trigger a margin call and aggressively close your trade to protect your own funds, okay? That security deposit that you are paying, remember, which is your margin, the broker will take all that money, and that is your $2,000. So again, the pros don't really look at how much they can make. They actually look at the total market exposure. Food for thought. So again, the pros don't really look at the financial gain. They don't look at the number, which a lot of us beginners do look at. They look at total market exposure, which is how much am I willing to risk and how much is my exposure on this particular trade. And then how do I manage it? Because remember, we are risk managers. Capital preservation is our number one priority. So your risk is always tied to the full volume of your lot size. So whatever lot size you decide to use, that is your risk exposure. And that's how I want us to think about the markets whenever we look at it anymore. What lot size am I going to use? So not just the small deposit that you put down, but your lot size will determine how much your risk exposure is. Are you risking the entire full 2,000? Or are you risking maybe 10% of that, which is $200? Or are you risking a percent of that, which is $20? Now, there's one final critical mechanical rule that we must agree to before you even think of starting to trade, right? So if you borrow money from a bank, let's say in Nairobi, your local bank, to buy an asset, what does the bank expect you to pay on that borrowed money over time? Exactly, interest, right? So in Forex, every single trade involves borrowing one country's currency to buy another. So every day at exactly 5 p.m. Eastern Standard Time, which is midnight in many parts of the world, the global market marks the official end of day trading day. Okay, so they close the trading day and then it flips over to the next day real quick. So if you hold a position past this 5 p.m. cutoff time, then your broker must automatically roll it over to the next business day, which is why sometimes if you look at the charts at around midnight, there'll be a quick gap because we are moving from one trading day to the next and they're closing those positions and swapping it to the next. So this rollover to the next trading day is what we call a swap. Okay, so then this is where the swap and rollover fees comes into play. Positive swap, which is an interest. So if the currency you bought has a higher central bank interest rate than the currency you actually borrowed, then your broker actually pays interest into your account. That becomes a positive swap on your account and you'll have a slight positive. Negative swap, on the other hand, is if the currency you bought has a lower interest rate than the currency you actually borrowed. So then you pay a small overnight fee to the broker. So then how can we be proactive about this and objective? I don't want to be paying more fees. I'm paying the spreads. I might be paying commissions. Then now there's swap fees if I'm holding trades overnight. How can I avoid these fees entirely is what you might be thinking at this point in time. I don't want to deal with interest rates, negative swaps, positive swaps, calculating overnight conversion fees, etc. It just sounds like a lot. Is there a way to avoid all this completely is the question. Absolutely. And the solution is simple. Become a day trader. If you make it an absolute rule to wrap up your operations, secure your profits, close all your positions, and completely close everything before 5 p.m. Eastern Standard Time, or daily closing bell, then you will never pay or receive a single cent in swap fees. The what and the why is a question on what exactly is day trading and why would you prefer to not pay swap fees? Well, again, day trading, swing trading, scalping, those are all types of trading styles that we'll get into later on, and then we'll get to understand what exactly it is, because you can also, just like the spread, you can accommodate the swap fees and the spreads and the commissions in your trading style, in your risk exposure, risk to reward, just so that you don't have to deal with all these things. So again, the key takeaway from this particular video, not to make it too long, is that managing your macroeconomic direction and understanding of what exactly is happening politically, geopolitically, but also in the different countries and how the economies are performing, and matching it with strict risk management, lot sizing, and risk exposure is how you transform from a retail trader or gambler to a highly profitable business operator. Because again, it's not about timing the market, it's about time in the market. So if you agree that treating your trading account like a professional business is the only logical way to secure your financial future, then we need to master the exact technical units that we use to measure and calculate these market moves, okay? So in the next video, let's talk about fundamentals. Let's talk about pips, pipettes, and point calculations, just showing you how to determine the exact dollar value that you're going to be risking before you ever actually commit to a particular trade. So hit that subscribe button, keep your risk management tight, and let's keep executing, because we want to earn in dollars and spend in Kenya shillings, and that is the name of the game.